think it's one of the best places for LPs to be invested in at the moment. And I say one of because obviously we think that places like private credit as well as secondaries are also good places to be in. But specifically for infrastructure, we believe that we're really positive on this asset class because, as you rightly mentioned, in terms of inflation, so infrastructure assets have historically performed well in times of high inflation. So take North America, for example, infrastructure assets has outperformed by an average of 4% in times of higher inflation than compared to the norm. So what this does is really to form a natural hedge for inflation in investors' portfolio vis-a-vis some of the other asset classes such as fixed income, which forms really a large part of some of the investors' portfolio. And the other aspect, which you mentioned on interest rates, I think there is impact of higher interest rates on infrastructure, but it's really impacting one of the more core end of the spectrum of infrastructure. So what we're really doing is really focusing more on the core plus to value add end of the spectrum, where the returns is really driven by 50% in terms of capital appreciation and 50% income. So it's really less impacted by rise of interest rates, for instance. And one of the areas that I think is really attractive about infrastructure is really the opportunity to invest into a mega trend of energy transition. So infrastructure allows investors to be able to invest into this theme, but without taking too much early stage or technological risk. Yeah, I think that's a great question. I think transition to net zero is a big area, but within that, energy transition is one of the most critical areas. So the term energy transition really encompasses a very wide spectrum of opportunities, from really early stage or more VC opportunities to later stage and more proven technologies. So within infrastructure, what we are really looking at is more late stage and assets that are moving into more stabilization phase. So within that set of opportunities, we are looking at three areas. First is in power generation, and that's where it's renewable power generation, predominantly in wind and solar. The second area is really in energy transmission. So today, most of the renewable energy is still being generated in places where it is, in other places that where it's being used. So take US, for example, most of the renewable power today is being generated in the Midwest, whereas most of the energy consumption needs is really in the consumers in the coastal cities. So the ability to transmit energy from point A to point B using critical high power voltage transmission lines, for example, is really the key to electrifying the grid. And the third part is really in energy storage. So today, you know the infrastructure in terms of renewable power, this is really still quite intermittent. So think about solar, think about wind. So we believe there are huge opportunities in areas such as underground hydrogen storage that enables other parts of clean energy to step in and provide that base load to provide complement to that more intermittent source of renewable power. And equally, there are huge opportunities in battery storage and also new technologies like vehicle to grid, which is important in a place where electric vehicles are much more prevalent. So particularly, I think that's a really difficult question because there are really so much on the minds of LPs today. And I think some of the top considerations are really downside protection. So you talk about the environment being high inflation, high interest rates, but investors are really also looking at that downside minimization in other economic scenarios, such as economic slowdown, which I think we are experiencing today, and also the potential of recession, which we are potentially looking at in the future as well. And the other aspect is distributions. So you might have heard from LPs time and again, distribution, distribution, distribution. So today, investors are much more focused on distributions and the return of capital than they are on the IRR returns today. I think the last aspect is really fees. I think in an environment that is so high cost of capital, high interest rates, investors are really focused on minimizing that gross to net ratio. And I think that phenomenon is likely to continue into next year. Yeah, I think, well, opportunities are still abound for investors. The first one that comes to mind is credit. So with high interest rates and also rising interest rate, I think private credit is really in a golden era, providing investors with high total returns. I think even in infrastructure, which we are talking about here, senior debt has been said to be the new core. So senior infrastructure debt is achieving mid to high single-digit returns today, and that has really impacted investor appetite for some of the most core end of the return spectrum. The second area which I talked about is the need for distributions and return of capital. So this is where secondaries, I think, is really interesting. So ranging from private equity secondaries to infrastructure secondaries, investors are really looking for that early distribution profile and also that J-curve mitigation effect. And the last but not least, I really think that there's a lot of opportunities within the transition to net zero and sustainability. And I think the path to net zero is a long one, right? And I believe that private capital, being patient capital or more long-term in nature, is really perfectly aligned to help to transform every aspect of which how we work, live, and play in this path to net zero. But as investors, we also need to be aware that many parts of the opportunity are also very hyped. So being able to tell and be very clear and rational about which opportunities are really going to benefit and which are not, I think is really important today.